Welcome to the Wall Street Geek, where geek is the word, helping you to become better informed about important money matters. But first, I've got a story for you. Now, when I was in college, I used to take road trips with friends around Houston and in grad school with friends around San Francisco. A popular thing at the time was to make a mixtape before the trip. A guy that I was dating in college loved club music. I mean, I don't really get it. I think it's manufactured, but he really loves it. So one song on the mixtape, one club music song was bearable. I could live with that, and I could let him live with that. But too many songs on the mixtape like that, especially one after another, I mean, he really did that at his own risk. So how the mixtape was put together was a factor of minimizing the risk of irritating his girlfriend, which leads to today's topic. Today's topic is how to build a low-risk portfolio, or better yet, how to understand the risks that may be present with the investments that you own. Investors who are aware of how to measure and monitor portfolio risk were less likely to lose money as the market collapsed, even though it seemed as if every single asset class was taking a hit. You just need to understand what in the global economy may impact your portfolio's performance, and, most importantly, how your portfolio will react to it. So let's start with understanding how your portfolio reacts to things. This is also known as understanding your portfolio's risk characteristics. There are many characteristics like alpha, beta, correlation, but let's start with a deep dive into one that all investors should understand, and it's called standard deviation. Now, standard deviation is a wonky way of saying volatility. And in finance, we're attempting to measure the volatility of returns or prices. And that'll tell you whether or not you've got a stable investment. Now let's measure the volatility of Google over the past 30 days, which is a 30-period standard deviation. Now this is how you calculate it. Step 1, average the closing prices over the last 30 days. You do this by summing prices and dividing by 30. Step 2, for each day, subtract the average closing price that you just calculated from the actual closing price. That's the deviation for each day. Step 3, square each period's deviation, add them together, and divide by 30. And finally, take the square root. That's your standard deviation. The smaller this number is, the less deviation the price made from the average value during that period, and thus the less volatile that investment was over that period. If it's a time period that looks similar to the one that's coming up, you may be able to expect the investment to perform similarly. You can also plot daily returns over a particular period versus how many times that return was observed over that period. If the values fall into a normal distribution curve, you can apply further statistics to predict future movements. For example, here we can estimate that 2/3 of the time, returns will fall within one standard deviation of the mean, and 95% of the time, returns will fall within 2 standard deviations of the mean. One year, returns may fall on the upside of the average, and another, the returns may fall on the downside. So if you have a highly volatile stock with a high standard deviation, one year your returns may be way on the upside, which is great. But if you hold on to it for a long time, and if it continues to be volatile, you may end up eroding your principal if returns fall way on the downside too many years in a row. This is why blue chips are popular with low-risk, long-term investors. Blue chips usually have low standard deviations, so even in a bad year, the returns stay pretty close to the average expected value. Standard deviation is just one of many risk factors. Another is correlation. Correlation to a benchmark may help you predict which way your returns may head. For example, if you own a stock that's highly correlated to a measurable indicator, whether it's a sector index or an economic indicator like the jobs numbers, you may use the fact that your stock is correlated to have a feel for which way the price may go based on information about the thing it's correlated to. For example, I'm not a huge fan of club music. I'm sorry. So if you play it, you know that I may react badly to it. So my mood is negatively correlated to club music. Another risk characteristic called beta will tell you how much of a reaction you'll get. A tech stock, for example, usually has a beta over 1 to the overall market. So if a tech stock has a beta of 1.5, it's 50% more volatile than the overall market. When the market goes up, it'll go up 50% or more. But if the market goes down, the stock may go down 50% or more. So let's put it all together. Risk characteristics like these form the basis for risk models like the capital asset pricing model, Black-Scholes, or the efficient frontier. All take the risk characteristics of an asset or group of assets and help you predict returns and prices, or help you build the highest return portfolio at the lowest amount of risk. That's great. One caveat is that risk characteristics are often based on past information, and the past doesn't predict the future, like you've heard before. So your best bet is to ensure that you're measuring over time periods with similar characteristics as today. For example, if we're in a bear market, look at your portfolio's risk characteristics during past bear markets. And one last thing, calculating risk characteristics of a portfolio admittedly involves a lot of math, and unless you enjoy mining data and manipulating it in programs like Excel, you can get software to calculate this for you on your individual securities and on your portfolio as a whole. So that's it for today. We covered key risk characteristics like standard deviation, correlation, and beta. And we subsequently discussed how you can leverage information about security risk characteristics in risk models like the capital asset pricing model, which may help you determine your future portfolio returns and how many shares to buy of each stock in your portfolio so that risk stays low. By understanding the volatility, correlation, sector exposure, and other risk factors in your portfolio, you can watch the news, you can read The Economist, you can talk to your friends, and you can determine how events or things like the Dow plummeting 300 points in a day will affect your portfolio. For example, if your portfolio was negatively correlated to the Dow index, and you can build a portfolio with investments like that, then you would have been one of the few people that slept at night in 2008. And if this sounds like a lot of math, you're not alone. There's software out there that can tell you if you may have a risky portfolio. You can also work with an advisor that you know and trust that uses portfolio risk analysis. Either way, it's a good idea to understand your portfolio's personality so that you can have a better idea of what to expect in the future. So thanks for listening. This is the Wall Street Geek, helping you to become better informed about important money matters. So until next time, live long and profit. Bye.